Hello, everybody. Welcome to today's webinar brought to you by the Clean Energy States Alliance. We'll give folks just a couple more minutes a couple more seconds actually to finish logging in. We have quite a few registered to attend today's event, and we're looking forward to hearing this discussion. So today's webinar is brought to you by the 100% Clean Energy Collaborative, which is a project of the Clean Energy States Alliance. Today's webinar title is, Should a Carbon Tax Be Part of the Strategy for Achieving 100% Clean Energy? Before we get started, I'm going to go over a quick logistics slide with you all to just let you know how the webinar will be arranged today. All of our participants will be on mute. We will not be able to hear you, but you can choose how you hear us, either through your computer's speakers, or you can dial in using the telephone. You should see on your screen this webinar console, which will give you the ability to choose which method you'd like to listen to us. And then you also see an orange arrow here, which you can click on to push this console off to the side so it doesn't interfere with your viewing of the presentation slides. We're going to ask that you submit questions throughout today's event by entering questions here in the question box and hitting the send button. That will queue up your question on a list, and our moderator will get to your questions as time permits at the end of today's presentation. Today's webinar is being recorded, and we will email you a link to this recording within 24 hours. The webinar recording will also be posted on CISA's website at the URL you see here on your screen. So again, this is going to be recorded, and we encourage you to type in questions as they occur to you on the questions panel and hit send. So with that, what I'd like to do is introduce to you today's moderator. That will be Warren Leon. Warren is the Executive Director of the Clean Energy States Alliance. So Warren, please go ahead.
Hey, thanks very much. Welcome, everybody. We have a very important topic to focus on today, but let me first tell you a couple of things about the Clean Energy States Alliance in case you're not familiar with us. We're a national membership organization composed of energy agencies and other public agencies in 20 states across the country. You can see our members up on the screen. And one of our projects is the 100% Clean Energy Collaborative, which is an initiative in which states that have adopted 100% clean energy goals for their electricity sector are working together, cooperating, sharing information so that they could learn from each other and tackle issues that they need to tackle in order to achieve the goals they've set for themselves. They have meetings just among the states, but we also hold events like this one where we share ideas and information related to the achievement of 100% goals with a wide range of stakeholders across the country. And Maria, if we could see the next slide, I want to introduce today's speaker and tell you a little bit about today's event. We're really fortunate to have with us today Gilbert Metcalf, who's the John DiBiagio Professor of Citizenship and Public Service and also Professor of Economics at Tufts University. In addition, he's a research associate at the National Bureau of Economic Research, and he's a university fellow at Resources for the Future. His primary research area is applied public finance with particular interests in taxation, energy, and environmental economics. During 2011 and 2012, Gib was Deputy Assistant Secretary for Environment and Energy at the U.S. Department of Treasury. And while he was there, he was the founding U.S. board member for the UN-based Green Climate Fund. Among his many publications is the book Paying for Pollution, Why a Carbon Tax is Good for America. And today he's going to talk to us about why he believes a carbon tax can play an important role in helping to achieve 100% clean energy, and why economists like him think a carbon tax is such a good idea. So, Gib, let me turn it over to you.
Thank you, Warren. It's a pleasure to be here and to speak to this group, and I trust you all can hear me. And let me proceed. So my topic is what role a carbon tax should play. And I, of course, came up with this topic before the election was finalized. And that will clearly, as we think about where Congress is, that will affect the answer to this question as well. I don't really need to go over these key facts, but I think it's really important to keep emphasizing to people we speak with that scientists agree about climate change. There's no disagreement. They agree that it is real and it is us who is causing climate change. There are major damages, but there are things that we can do. And Tony Lazarowitz at Yale, who does polling on climate polling, I think has made a strong case for why these key facts we should just keep hammering away at. So let me just skip over the fact that we see increasing temperatures. This is data going back to 1850. But it is not just mean temperatures that matter, it is also the variations in temperature. So there's significant variation, and certainly and particularly in the polar regions, we see much higher increases in temperature in the winter times. And of course, this has led to melting of sea ice, which then reduces reflectivity, which then adds to the climate problem. Climate extremes are becoming more extreme, if you will. These are data that NOAA puts together. They have a climate extremes index that you can see. The green line is sort of smooths the annual numbers, and what you see is that we're seeing dramatic increases in extreme weather, whether it's temperatures, high temperatures, low temperatures, extreme rain, extreme drought, and so forth. And climate change is costly. We now have a much more robust and empirically based literature on the damages if we refuse to act or if we fail to act to address our climate change problem. You might think I'm showing you a map of the most recent election of where Republicans and Democrats voted, but in fact what I'm showing you is the red counties are counties that experience the most severe damages from climate change. The blue counties, which include many of counties in the northernmost parts of the country, actually see some reductions in climate-related costs, and this is predominantly reductions in heating costs in the wintertime. But there's a lot of variation, and the damages could be extreme by the end of the century if we fail to act. So what are our options? Well, if you ask an economist to focus on what is the most efficient, the most cost-effective, meaning that giving you the biggest bang for the buck, the least expensive way to reduce emissions by a given amount, we know that regulation is reasonably costly. And it has the political risk, as we've seen, that with at the federal level, with a new administration coming on board, they can move to undo regulatory steps taken by a previous administration. We've seen that with the Trump administration that attempted to undo much of what Obama's administration had done. And now we're going to see the same thing happen again once Biden takes office in January. So this produces some risk for businesses that are trying to make long-term plans. Historically, we have relied heavily on subsidies for clean energy, things like investment tax credits for solar, production tax credits for wind power and electricity. When I say these are inframarginal, that's economics jargon for we're giving money to people who would have done some of this stuff anyway. So I got a fairly significant, roughly $10,000 subsidy for buying my electric car. I'm delighted to have that $10,000, but I probably didn't need it. I certainly didn't need it, and it likely wouldn't have affected my decision to buy the vehicle. So I'm inframarginal in that sense. The other issue with subsidies is they lower the overall energy price, and that undoes one of the mechanisms by which we can reduce emissions, which is to reduce the demand for energy in general. A lot of people talk about the value of information programs and the use of offsets. These certainly can help at the margin, but they're not going to give us the big emission reductions that we're going to need to address the climate problem in this country and globally. And finally, pricing emissions, of course, is the textbook answer for any card-carrying economist, and that's certainly my answer as well, but clearly it's a politically challenging approach. Let me just speak for a moment about a very popular approach that I think we've seen it used a lot, and we're going to see it used even more, I think, in the years to come. And this is the notion of intensity standards. And an intensity standard mandates a certain minimum percentage of a given input, for example, a given amount of clean energy in the overall energy mix. And what this means effectively is you combine a subsidy on, on some favored input and a tax on the disfavored input. And examples of this are low carbon fuel standards, which California has put into place. At the federal level, we have renewable fuel standards. Both of these are subsidizing ethanol while effectively implicitly taxing gasoline. Similarly, renewable portfolio standards, they require a certain minimum percentage of electricity from clean sources, and these effectively subsidize wind and solar while taxing natural gas and coal-fired fuels for the production of electricity. So these are popular, but they are expensive. And by expensive, because we're combining a tax and a subsidy, it leads to, as opposed to just simply putting a tax on the disfavored fuel, these policies end up having very high marginal abatement costs, meaning what is the cost of reducing a ton of carbon dioxide from the fuel mix using these approaches. And various estimates have been done, and they show that, for example, a low carbon fuel standard, as in California, is extremely expensive. It can be as much as $700 per ton of carbon dioxide for a program that reduces carbon dioxide emissions by less than 10%. So this is a hugely expensive subsidy or standard, intensity standard. To put this in context, the social cost of carbon, which is an estimate of the damages to society from releasing one more ton of carbon dioxide into the atmosphere, is somewhere in the estimate, a federal estimate at the end of the Obama administration was about $55 a ton. Many argue that that's too low, so let's double it and call it $100 a ton, but it's certainly much less than $700 a ton. For renewable portfolio standards, research by scholars at the University of Chicago suggests that the cost per ton is on the order of $100 to $500 per ton from existing RPS programs. So they work, they reduce emissions, but they can be extremely costly. Now, how about the two most common ways of pricing emissions through a market mechanism? We have a carbon tax, which we see, for example, in British Columbia. They have a province-wide carbon tax on fossil fuels consumed in the province based on the carbon content of the fuel. Cap and trade systems we see in California's cap and trade system, or regional greenhouse gas inventory here in New England, or European Union's cap and trade. Both of these are a way of putting a price on emissions. I like to say they use the power of Adam Smith's invisible hand to move markets in a way that's socially beneficial, but they do it in a way that allows Adam Smith's invisible hand to have a green thumb by taxing pollution. Either of these are more cost effective than regulatory approaches. I think there are some economic advantages to a carbon tax. For one thing, you don't get the sort of price volatility that you can see with cap and trade systems. Moreover, it's easy to implement and administer these policies because we have existing excise taxes on most fuels in this country, both at the state and federal level. So it would be quite straightforward to administer such a tax. In fact, no additional reporting would really be required by firms. And the last issue is that complementary policies have no impact on a carbon tax, but they do undermine cap and trade systems. And what do I mean by that? Well, if you look at California's system, they have a cap and trade system that limits emissions to some cap, but then they impose other programs like their low carbon fuel standard. And all the low carbon fuel standard does is it reduces emissions in the transport sector, but that now creates some headroom in the cap and trade system, which means it lowers the price of allowances and allows other firms to come along and release emissions until we're back at the cap. So once you combine these other programs with a cap and trade, it can lead to low prices in cap and trade systems, which is problematic. Now, there are some advantages to cap and trade, and perhaps the most salient is a political advantage, is that you might think that it is politically more feasible. I think that was probably true a decade ago. I think with the failure of the Waxman-Markey bill in Congress more than a decade ago, roughly a decade ago, I'm not sure that's still is the case. Certainly the discussion in Washington in the past year or so has been more around putting a price on carbon through a carbon fee or carbon tax, but that's a better topic for a political scientist than me. If we look around the world, there are 61 carbon pricing initiatives. So there's a lot of places to look for evidence on how these systems work, split roughly half and half between cap and trade systems and carbon taxes. This is a little hard to see. It's from a World Bank publication put out annually called States and Trends of Carbon Pricing. But the horizontal axis tells you what share of a jurisdiction's emissions are subject to a particular carbon pricing initiative. For example, this is France's carbon tax. And so this says that roughly a third of their emissions are subject to the carbon tax. And the vertical axis gives you the price, roughly $50 a ton. And the size of the circle tells you how much revenue is being collected with this. The purple circles reflect carbon taxes and the green circles reflect cap and trade systems. So you have the European Union emission trading system. Here we have California's cap and trade system. And the one thing that stands out with this table is if you want ambitious prices in a carbon pricing system, you need to move to a tax, or at least historically you've needed to go to a tax. These are the systems with a price of at least $50 a ton, and I think that occurs again because of this complementarity problem I mentioned before. Let me just briefly discuss some myths about carbon pricing that I think it's important that we all understand what are facts and what are fake news, if you will. The first is it's often said that the economy will be adversely impacted by a carbon tax. The economy will tank if we put a price on emissions. And we now have enough experience with carbon taxes because the first ones were put in place back around 1990. So we have 30 years of experience. So Jim Stock at Harvard and I did a study looking at the 15 countries in Europe that have carbon taxes. And we find no evidence that they harm GDP growth or job growth in those countries. And what the graph shows below is we did a simulation based on our statistical work saying, well, what if we increase a carbon tax? What would be the impact on GDP? And the red line in the middle is the point estimate. And this actually suggests that GDP would perhaps go up a little bit, and that's because we're redirecting the revenue towards more efficient uses that come out of a carbon tax. But these colored bands around sort of tell you something about the precision of the estimate, and since zero is contained in those bands, we can't reject the idea that there's zero impact of a carbon tax on economic growth. But what we can reject is the idea that there is large negative impacts. There's simply no evidence to support that. And we find that for GDP, we find it for job growth, we find it if you look at countries with high carbon taxes, low carbon taxes, we just don't find any evidence of economic damage from carbon taxes. And again, it's because we collect this revenue and we're going to do something with it that's productive. The second myth is that carbon taxes will have burdens that disproportionately impact lower income households. Or in the jargon of economics, these taxes are regressive, meaning that the tax is a higher share of income for low income households than for high income households. This too turns out to not be correct or is overblown. For one thing, one of the things that a carbon tax does, based on research done by colleagues of mine at Stanford and Resources for the Future, is that a carbon tax actually hits owners of capital more than it does workers in terms of what happens to the returns to capital and wages. And since capital is predominantly owned by rich folks, this actually adds a progressive element to a carbon tax. And the other aspect that is often ignored is that transfer income, whether it's Social Security or other kinds of programs, transfer income is a higher share of income for lower income households, and transfers typically are indexed in this country. So these sort of provide some progressivity. And moreover, you have revenue with a carbon tax. A US Treasury study indicated that a carbon tax that started at about $50 a ton nationally would collect over $2 trillion over a 10-year period. You can rebate that money in a progressive fashion. So for example, the Climate Leadership Council, a bipartisan group in DC, is promoting the idea of carbon dividends, where the money is returned to every household on an equal basis. Moreover, regulations tend to be regressive, and regulations don't raise any revenue that you can use to enhance progressivity. So I think this regressivity argument with a carbon tax is simply incorrect. This is a figure from the Treasury study that shows if we do rebate the revenue on a per capita basis, what happens to after-tax income as you look at low-income families, the lowest 10% of households, all the way out to the highest 10% of households. And you actually find that the rebate is higher than the higher cost of goods and services for low-income households. So in fact, on average, their after-tax income rises for the lowest income deciles, and it only actually falls for the highest income deciles, who have, of course, the highest carbon footprint. One concern that is also raised sometimes is that, well, the carbon tax puts a price on emissions, but it won't guarantee emission reductions. And I'll just note that that's true, but that there are ways to design a carbon tax to incorporate what I call a policy thermostat that automatically adjusts the tax rate so that you increase the likelihood of achieving some goal. So for example, if we wanted to set a goal of reducing emissions by 40% nationally over the next 15 years, we could add a policy thermostat to a carbon tax system that would help us achieve that goal. And that's actually gotten some interest from folks in Washington. The myth, well, the myth is the Republicans hate a carbon tax. Well, this is perhaps not a myth, but I think the real thing to say is that the Republicans, and this is painting a very broad brush, so let me not paint every Republican as feeling this way, but Republicans on average tend not to be keen on any kind of environmental regulation. So it's not just carbon taxes that they might be suspicious of, but but the fact is, we now have Republicans embracing carbon pricing, including people like Jim Baker, Henry Paulson, the Secretary of Treasury under George Bush. This is the Bipartisan Climate Leadership Council that calls for a gradually increasing carbon tax with carbon dividends going back to all Americans. And the deal that they're proposing is that we have significant regulatory rollback in order as the price of having a carbon tax. This is garnered a remarkable sort of cross-cutting layer of support from Republicans and Democrats alike. Greg Mankiw as a Republican, who has been a longtime supporter of carbon taxes, but also the late Martin Feldstein, and as I say, Jim Baker and George Shultz in the Republican Party. And you also have a significant number of companies that have signed on for supporting this proposal as well. And of course, for them, again, the goal is to have a reduction in regulations. And I think there's a deal there that could be struck that would be satisfactory to the business community and to the environmental community, folks like Environmental Defense Fund, Conservation International, Nature Conservancy. Does the public hate carbon pricing? Not according to polling done by the Yale George Mason University. If you ask them whether fossil fuel companies should pay a carbon tax, you see about 2/3 of registered voters saying yes. More Democrats support this than Republicans, but even half of Republicans support this view. And you get similar levels of support for the Climate Leadership Council's fee and dividend approach, where we take the carbon tax revenue and return it through household rebates. So again, I think there are potential deals that could be struck. Now, how do you design a carbon tax if you want to go down that road? Well, to me, the answer lies with this person. This is Willie Sutton, the famous bank robber from the 1930s. When he was asked why he robbed banks, supposedly he said, because that's where the money is. Why is that relevant? Well, where do we tax? How do we levy a carbon tax? Well, 3/4 of our emissions come from fossil fuel combustion, so we clearly tax those. And there's probably another roughly 10% of emissions that you could easily include in a carbon tax space, including some non-combustion carbon dioxide emissions, methane, and some of the the HFCs and PFCs. But I want to be clear that a carbon tax would not be sufficient. We need major investments in R&D because we need to develop the technologies, the zero carbon technologies, at a price point that makes them acceptable and affordable to the public. We need storage technologies, battery technologies. We need carbon capture and sequestration, and we need new zero carbon technologies. And here I include nuclear power. As an old guard 1970s anti-nuclear power person, I've really had to come around and say there may be a place for nuclear power, but clearly we need new kinds of plants that are affordable and safe. And I think we're not there yet with the technologies we have. We also need to invest in climate resilience, and we're going to need some regulations for hard to tax sectors in agriculture and elsewhere. And we also need we're going to need to bring down barriers to things like interstate transmission lines to move electricity from where we can produce it with wind or solar efficiently to where the populations are consuming the electricity. We have a number of problems in there that will require action by FERC and through executive action as well. Let me just highlight again, just to emphasize the importance of R&D. This graph here is showing battery range along the horizontal axis and the cost of an electric vehicle. And for 3 different snapshots in time, you've got 2011 and 12, In the blue, you've got the diamonds. I can't see what color this is. I'm colorblind, but the diamonds tell us what the prices look a few years later. And now a few years later, we're beginning to see low cost, high range vehicles appearing. So what this really indicates is the R&D is going to be critical to bring these curves down to make electric vehicles, for example, affordable and address the range anxiety problem that we need to be confident that we will not run out of juice in our battery when we're barreling down the highway. So how do we get to a national policy that, whether it's a carbon fee or anything else, that's a comprehensive policy that puts us on a path to a zero carbon economy? I think there's the wrong way. And what we discovered with the yellow vest movement in France is that Macron took an approach that was piecemeal. He was doing a number of tax revisions, many of which were actually had nothing to do with climate policy, but were cutting taxes on the rich. And then the straw that broke the camel's back was then to raise a carbon tax, which already existed in France, raising the tax rate, but doing nothing to address the needs of rural citizens for whom public transportation is not so great. So we had a piecemeal approach that led to great protests against the Macron proposals, and I think it's incorrectly been viewed as specifically focused on the carbon price. I think it really is that Macron did not articulate and get popular support for a framework to support the reforms he wanted to do. How do we do it the right way? I think Ronald Reagan had the right approach back in 1984 when he gave a State of the Union address calling for fundamental tax reform. He laid down a very simple but clear set of guidelines for Congress to follow as they negotiated a tax reform package that became the Tax Reform Act of 1986. And it was very simple. It was that the reform should be revenue neutral. It should not collect any more tax revenue or any less tax revenue than the previous law, and it should be distributionally neutral. And the reform was, to a large extent, it followed his guidelines. So to me, what's required, and I think Ronald Reagan illustrated this, is the importance of a framework that's agreed upon by the players. And so what would the framework be? One possible framework is that it should be revenue neutral. Whatever money comes in should go out. Now you could debate whether this is the right element of the framework or not. It clearly was. It's an important framework if we're trying to get bipartisan support for a carbon tax. I think it should be fair. We should not be disproportionately burdening low-income people or particular sectors. It ought to lead to streamlined policy, streamlined regulatory policy, and it ought to cut emissions a lot. That's going to be important. And I think there are ways to do that. But let me just say, in wrapping up, I'm almost done. Let me just say a few things about what do we do if we don't have a national carbon price. Well, then I think our fallback is a piecemeal federal approach, as well as continued action at the state level. And the benefit of this approach is that there's much we can do through executive action, and I think there will be much that the Biden administration does do. The drawbacks are that it's going to be more costly, and we again are subject to this problem of potential rollback by a future administration. But if we look at our emissions in the United States, and which sectors are the source of those emissions, that suggests the following. We could do a clean energy standard, a clean electricity standard for the quarter of our emissions from electricity. This would address the coal and natural gas in these sectors. We could then, and especially as we decarbonize the electricity sector, we can continue to ramp up fuel economy standards under CAFE and promote the use of electric vehicles, and so shift transportation away from oil and into electricity much of which hopefully would be renewably sourced. Industry and commercial, residential, building sector, agriculture, these are tougher nuts to crack, but I think there's much you can do through standards and regulations to reduce emissions there. So I think that's probably the kind of approach that we'll see taking in the next 4 years or 8 years, depending on how long Democrats, the Biden administration is in place. And overarching all this, I think we will certainly need aggressive spending in research and development. We can continue tax incentives for green power, as well as looking for ways to remove barriers to the adoption of zero carbon energy sources. A couple of comments on state policies. I think it's quite remarkable what we're seeing nationally with the use of renewable portfolio standards and clean energy standards across much of the United States. So I think failing to have federal action, we can continue to see action at this level, albeit it's expensive, as I mentioned before. However, this is not a panacea for federal action, because there are certain types of initiatives we need to take. For example, encouraging greater energy storage for dealing with the intermittency of renewables. And there we have seen less progress at the state level. And again, I think that's not surprising. And this is where we should see action at the federal level. And finally, does this have to be either or? Well, it doesn't really, and this is a graphic from a new paper by Chris Knittel and a colleague. Chris is at MIT Sloan School. He's done a very interesting study where he asks the question, what if we combine smart regulation with a modest carbon tax? And I'll just show how to read this graphic just to illustrate one of them. So if we take a renewable portfolio standard, this line with the squares, if we rely for a given level of emission reductions entirely on an RPS, we will index that to be a cost of 100. And as we move to the right, we're getting an increasing amount of reductions from the carbon pricing. And what we see is that for a modest amount of reductions that are generated by the carbon price, you can cut the cost of reducing emissions dramatically. So even with something on the order of 15 to 20% coming from the carbon price, you can cut the cost by about 2/3. And obviously, if you go all the way out to relying on a carbon price for 100% of the cut, that gives you the maximum cost reduction. But if the view is that we might be able to get a modest carbon tax, then you can still get some significant reductions. Politically, I'm not sure. I'm not sure that you can that the lift is any lighter to get a small carbon tax versus a big carbon tax. I think getting a carbon tax period is going to be a heavy lift. So I'm not sure there's a benefit to this, but I just point that out. So in closing, we're in a new era. We have a new administration that's going to move aggressively on climate. Obviously, how much they can do depends on who wins the Georgia Senate, two Georgia Senate races, as well as the mood of the Senate for taking climate action. But there is support for carbon pricing that is bipartisan, but I don't want to leave you with the impression that it's going to be an easy political lift. So, but having said that, I think it's extraordinarily important that we make up for lost time, because every year it's going to be more and more expensive to decarbonize the economy. So with that, let me stop and thank you all for your attention. I look forward to your comments and questions.
Hey, thanks very much. That was a great presentation, covered a lot of ground very efficiently, just like a carbon tax. And let me ask you a few of the questions. You talked about places that have implemented carbon pricing up till now. Are there any locations where you think they've done it well and where it's been shown to be popular and have real legs?
So I think if we're talking a carbon tax, let's start with that. Yes. I think British Columbia is the textbook case for a jurisdiction that has done an economy-wide carbon tax that actually has been quite popular, because one of the things that they did was they made sure that the money that came in went out again, both in a combination of reduced tax rates, which were targeted towards small businesses, so that generated some support from small businesses. But they also gave household rebates, similar along the lines of what the Climate Leadership Council was proposing, and that was quite popular. Now, it's true that when there was a period when conservatives took over the provincial government and they sort of paused the carbon tax, but recently they've gotten back on a track towards raising the rate. The plan now is to raise it until it reaches $50 a ton Canadian, at which point it plateaus until other provinces have similar carbon tax rates.
Okay, a couple people asked if you could talk a little bit more and explain again why regulations tend to be regressive.
Well, two reasons. If we think about regulations that raise the cost of goods and services, the main reason, well, of course, that's a generic statement, and I should be clear that you have to look regulation by regulation. But for example, if we look at fuel economy standards in CAFE, this is a good example. CAFE raises the price of new cars, which at first blush, you might think, well, wait a minute, who buys new cars? It tends to be people with more income. And so you would think that CAFE, to the extent that it raises the price of automobiles, would be progressive because higher income households are buying new cars. But the other thing that CAFE does is that once you impose the fuel economy standards, you're making new cars more expensive relative to used cars, because the fuel economy standard doesn't apply to cars that are already in the marketplace. And so the result is that households hold on to their used cars longer, and that has the result of drying up supply of the supply of used cars in the used car market, and that actually raises the cost of used cars to the predominant buyer of those cars, who are lower income households. And it turns out that adds a significant regressive impact to this policy. So it's those kinds of sort of economy-wide impacts that you have to follow through, where you can get these unexpected results, like a CAFE being regressive.
Okay, let me ask you about carbon taxes and economic competitiveness. That, especially if you were to take the income from a carbon tax and, as you suggest, give it back to people on a per capita basis, it suggests that the production of goods would become more expensive because manufacturers would be having to pay a higher price for their energy. That would then make their products less competitive on the global market. Is that a concern?
It is a concern. I think it's more a political concern than an economic concern, for two reasons, but it is a concern, and there are also ways to deal with it. But there are two facts we need to take into, two things to factor in. The first is that if you look, and this is an issue for manufacturing. Obviously, if you're in a service sector, your energy costs are pretty trivial in the grand scheme of the cost of business. But for manufacturing, where this is a greater concern, it turns out that about between roughly 90–95% of all goods produced in the manufacturing sector are produced in sectors with very, very low energy footprints and very low carbon footprints. There are a few sectors, a small handful of sectors, that are very energy intensive. Think aluminum production, smelting. So there are a few of these sectors, but there are not many of them. So first off, it's not a general problem. It is a specific problem to a few sectors. And we can do border tax adjustments, whether it's tariffs or other approaches for these small handful of carbon intensive and energy and globally traded goods to address that problem. So I think that that's manageable. And the second thing to keep in mind is that this whole argument that if we put a price on our emissions, we're going to disadvantage ourselves against the rest of the world misses the fact that the rest of the world is putting a price on their emissions. Europe is doing it, Canada is doing it. These are our big trading partners. Even China is doing it, not as big a price as we would do. So in a sense, we could flip this around and say, why are we taking advantage of our trading partners by continuing to pollute when they're taking action? But again, the carbon tax, the border adjustment is a way to address the issue and really bring us online with the rest of the world.
Good. One person wrote in to ask, do you think that RGGI and other cap and trade systems in the country would dissolve if a federal carbon tax or dividend was implemented?
So let's take California's cap and trade system, which currently I think the price is for allowances is in the $18 range. I could be off a little bit, and someone can correct me, who knows, but that's roughly right. If we put a carbon tax in place that reduces emissions, it will slacken the cap, if you will, and so it reduces the allowance, the price of those allowances. And if the tax rate is high enough, it actually drives those allowance prices to zero. So the short answer is that if you impose a tax, it's likely to make the cap and trade system redundant. Now, and similarly for RGGI. Now, there are two views on this. One view is we should be doing climate policy at the federal level rather than state level, in which case it would be a good idea to get rid of these state level and regional programs. On the other hand, you might say, but wait a minute, California and the New England states who are part of RGGI are depending on the revenue from these programs to do a number of initiatives. And that's a legitimate argument, and that suggests that there should be some sort of perhaps some compensation to those early moving states and collections of states that moved to reduce their emissions through pricing mechanisms that raised revenue. And I think that'd be a legitimate argument that California should be making, Massachusetts should be making, that if we are serious when we get to the point, and I think it's only a matter of time before we eventually have a national carbon price, there ought to be some attention paid to how do we address the loss of revenue at the state level.
Okay, thank you. Someone else asked, you held open the possibility of new nuclear development. It's unlikely that the institution of a carbon tax would provide sufficient revenue to fund the development of new nuclear plants. How would you see that something like getting that technology online could come about?
So I think we have a number of issues with nuclear power. We have cost issues, we have safety issues, and we have spent fuel storage issues, as well as nuclear proliferation issues. All of these have to be addressed. But the cost issue, I think, is one that really demands a new form of technology, and this is not my area of expertise, but a new form of technology that perhaps are smaller modular nuclear reactors. There's very interesting work being done around the country with various innovative technologies that lead to less expensive and smaller plants, and plants that are safer to run as well. Now, having said that, we still we're a long way from that, and there's a great need for more research to develop these technologies, and that's where federal R&D spending is going to have to play an important role. And you're not going to fund that necessarily out of a carbon tax, but it's an expense the federal government is I think going to have to make, and I think one that the Biden administration is prepared to make.
Thank you. Well, let me ask a longest question that someone wrote in having to do with the Climate Leadership Council's proposal. And he writes, the Climate Leadership Council proposes a regulatory rollback along with the carbon prices you mentioned. With a carbon price, would regulations and policies like the Clean Power Plan become superfluous? And is the regulatory rollback necessary to strike a grand bargain with conservatives? And finally, do you agree with amnesty for historic CO2 dischargers?
Okay, let me separate that last part of the question out and handle that differently. I think we want to avoid a bait and switch. Well, first off, let me just start out by saying, and many of you on this call probably know this better than I do, that implementing regulations, a regulatory structure like the Clean Power Plan that's implemented through the Clean Air Act, through EPA, is an arduous process. It takes many steps. With the rulemaking process is a complicated one, and it's difficult to do. And so we should be very, very cautious before cavalierly discarding that system that has taken so long to put into place. So I would not suggest or argue that if we get a carbon tax, we should simply repeal the Clean Air Act or pass a law saying that carbon dioxide is not a criteria pollutant. That would be a huge mistake, because you don't want a bait and switch where we put a $25 carbon tax in place, repeal the Clean Air Act or the carbon dioxide component of it, and then all of a sudden we find the carbon tax rate doesn't go up, or even worse, goes down. That kind of bait and switch is simply won't be acceptable to the public and won't be acceptable to environmental groups. But what you could do is you could strike a deal with a moratorium where we basically keep all the apparatus, that regulatory apparatus in place, but put it in abeyance with the idea that so long as we are making at least as much progress in reducing emissions as we would have made through the regulatory structure, then we will hold it in abeyance. But if future Congresses are to step back from the carbon pricing, repeal it, reduce it, or otherwise reduce its effectiveness, then we have a snapback where the regulatory structure comes right back into place. I think that kind of approach you could do, and I think that's an approach that you could get political support for by both the business community and the environmental community. Now, on the question of paying for historic emissions, you know, that's kind of an ethical question, but the question that always occurs to me when I think about this is, well, who has benefited from our ability to burn cheap fossil fuels? Yeah, it's Exxon and the big oil companies and PBD coal. They've certainly made money through these businesses. But we also, as consumers of these fuels, have also benefited enormously from it, and we benefited as well through economic growth. So, to me, it's not at all clear that sort of trying to in effect collect reparations on the basis of historic emissions, it's not clear to me that that's productive. And quite honestly, I think it would be impossible to build any political coalition for. But again, I should be cautious because I'm not a political scientist. But I think it raises a lot of interesting questions in terms of who's actually benefited from our fossil fuel consumption over the past 100 years.
Thank you. Do you have any suggestions for how to help frontline communities, low-income communities who receive the greatest disparities during the climate crisis, how you could help them as part of an effort to attack emissions and implement a carbon pricing plan?
Well, if we put a carbon pricing plan in place, if I understand your question, that right away helps those frontline communities, because these are communities that already are suffering from high degrees of local pollution from industrial activity and the close proximity of road networks. And to the extent that we reduce our consumption of fossil fuels and shift away from the internal combustion engine toward electric cars, that reduces local pollution. So that's an immediate benefit for people in these communities, health benefits. If you were to do the Climate Leadership Council's carbon dividend plan, that also benefits people in these communities, because the carbon dividend checks would be a significant amount of money relative to their incomes, as opposed to what Bill Gates or Mark Zuckerberg gets. But having said that, you could certainly use you could use some portion of carbon pricing revenue for a dividend, and you could set aside some of it to provide resources to communities, low income and minority communities that have been adversely impacted by pollution, for economic development. There's certainly ways you could do that, use some of the revenue for that as well.
Thank you. I want to ask you about the carbon dividend ideas. Somebody was writing in saying that that sounds really appealing, and maybe this question gets more in the realm of political science, but they were saying, the average person on the street has heard about the concept of a carbon tax, and it sounds unappealing because it has the tax word in there, but very few people are familiar with the concept of a carbon dividend or cash back. Why do you think that concept has not gotten traction in the news or with the popular media?
Well, I think I can only speculate. I think there's an immediate focus when people hear tax. That's as far as they can get, and they stop listening beyond that. But I think there is a messaging and an amount of work that needs to be done to remind people that when we collect revenue through a tax, that it's not like that revenue just disappears. I mean, it may disappear as far as you or I are concerned, but it's going to go somewhere. And I think this is where the Climate Leadership Council has been quite brilliant, especially under the late Ted Halstead, who started the group, quite brilliant at creating more sort of visibility around the carbon dividend idea. One of the points about it that I think is interesting, when I met Ted Halstead and he was sort of lobbying me on this idea, I was a little skeptical because economists for years have been saying we should use the revenue to lower other tax rates to get an efficiency benefit. And Ted's point was that, well, A, it's very progressive, and so that's beneficial, and I agreed with that. But the other point is that we need pretty high carbon tax rates if we're going to significantly reduce emissions in this country. And the only way we're ever going to get political buy-in for those high rates is if people recognize that they're going to get a lot of money back. And so if high carbon tax rates mean high carbon dividends, you can build a constituency to support sustaining those rates. And I think that's a very powerful argument, particularly when you look at other kinds of tax legislation. When you have a tax in effect, there's immediately a constituency to support the tax, which is both the receiver of the benefits of the revenue, as well as the Joint Committee on Taxation, the combination of senators and congressmen whose committee it is that oversees the tax. and no congressional committee wants to see some of their power taken away by reducing, say, a tax. So I think politically that is a pretty salient and important point.
Thanks. Well, we just have a couple of minutes left. Is there anything else you would like to say that you wish you had said and didn't get a chance to say, or anything you want to reemphasize to leave it in our minds as we go about our business at the close of this webinar?
Well, let me throw out a provocative idea, and I do this slightly tongue-in-cheek, but not entirely. To me, I've always argued that if we can't get federal policy, then the next best thing is to have states enact policies that are as heterogeneous, meaning as different as possible across states, so that companies like Exxon or Dow, who are operating in many states across the country, have to deal with very different systems with different rates, different rules, because then you'll get the CEOs of those companies going to Congress saying, we can't take this anymore. Give us one federal policy, please. So I just sort of throw that out there as something to think about.
That is provocative and very interesting, and likely to be very effective. Well, this has been a great presentation, and thank you. And I received many comments already through the chat box, thanking you for what you did. And thanks to everybody who attended today. We'll be back with many future webinars related to 100% clean energy, and you can see a few webinars coming up on your screen at the moment. Thanks, everybody.
Thank you, Warren.